When the guy who ran the Treasury during the 2008 financial crisis tells you to prepare for something worse, you should probably listen.
Today, we are taking decisive actions to protect the U.S. economy. Today's actions are not what we ever wanted to do, but today's actions are what we must do to restore confidence in our financial system.
Welcome back to K-Shaped Economics. I'm Stephen J. Campbell, and I'm an active futures trader who's been reading consumer economy data on the ground level for over 20 years. And this one is telling you more than the headlines or even paywalled content will ever reveal. Henry Paulson just went on Bloomberg and said the United States needs an emergency break the glass plan.
This crisis is different, right? When you hit the wall and you're trying to issue treasuries and the Fed is the only buyer and the prices of the treasuries are going down and interest rates are up, that's a dangerous thing. And so the thing I am talking about now is we know, people say, when are you going to hit the wall? I obviously don't know. It's impossible to know. But the law of economic gravity, you're not going to know that. So, and when we hit it, it will be vicious. So we have to prepare for that eventuality. And I think we need an emergency break the glass plan, which is targeted and short-term on the shelf. So it's ready to go when we hit the wall.
Not for some hypothetical future problem, for a collapse in demand of U.S. Treasury bonds, the thing that's supposed to be the safest asset on the planet, the bedrock, the thing every other price in the global financial system is built on top of. And the official reaction? Crickets. Back to your regularly scheduled programming, everybody. See, here's what a Treasury demand collapse actually means in plain English. The U.S. government borrows money constantly. It does this by selling Treasury bonds. Investors buy them. That's the deal. But what happens when investors stop buying or start demanding a much higher interest rate before they will buy? Well, the government still has to pay its own bills. It still has to service the debt it already has. And if the bond market seizes up, the Federal Reserve becomes the buyer of last resort. The Fed just then prints money to buy the bonds that nobody else wants. And when that happens, you get a currency crisis on top of a debt crisis at the same time. So Paulson, he didn't mince words about what that actually looks like. He said that when it hits, it'll be vicious. That's not my words. That's the words of the man who had the authority to bail out the entire U.S. financial system in 2008 and is now telling you that the tools he used then wouldn't work this time. Now, watch what happens when you look at what's already in the data. The U.S. budget deficit has averaged around 6% of GDP for 3 straight years. Now, that kind of deficit was historically only seen during war times or deep recessions. But right now, we're running it during what the headlines keep calling a strong economy. Treasury yields have been rising. Foreign demand, particularly from countries that used to be reliable buyers, that's been softening. And here's where it gets messy. See, Paulson said Congress, they're not going to act until there's an immediate crisis. He said that directly, which means the plan he's calling for, the one that would require tax increases, closing loopholes, overhauling Social Security and healthcare, it's not going to be built until the wall has already been hit. And now that's not pessimism, though. That's just how the incentive structure of democratic politics works. Nobody votes to raise your taxes before a crisis. They simply do it after. So what you actually have is a former Treasury secretary who managed the last systemic financial crisis going on television telling you the next one does not have a solution ready whatsoever. And the market today, it mostly shrugged. But here's what that means for a K-shaped economy, see. A Treasury demand shock does not land on everyone equally. It never does. If rates spike and the Fed has to step in as an emergency buyer, inflation picks back up. Hard assets will hold value. People with real estate, equities, commodity exposure, they're going to get an inflation hedge. And people with cash savings, fixed incomes, hourly wages, they get eaten alive. The top of the K-curve has the positioning to survive a bond market shock. The bottom of the curve has a checking account and a car payment. And that's not a bug in how this all plays out. It's actually a feature that they built into the system. So Paulson is not predicting the collapse is going to happen tomorrow. He's saying the plan needs to exist before it happens. And right now, it just simply does not. The people at the top of the economy know that. They're already positioned. The question is whether you are paying attention before this headline gets written. Now, if you want to go deeper on this, the debt mechanics, what a treasury sell off looks like in real time, and where the macro data is pointing right now, subscribe and go check out my other channel called Not Leaving Las Vegas. It's where we use Vegas as a case study for the economy at whole. I do long form analysis there, and you might love it. I do videos every day on this channel, so throw me a like and a subscribe and leave a comment.